Okay, folks, I I hope you had a chance to read that email I sent yesterday, right? It lines up what's left in this class. Okay. So help me out here, Jake. What is the first thing that's coming due in this class? We have the third quiz on Monday, right? Okay. Third quiz on Monday. First 30 minutes of class. You have to submit the numbers into the spreadsheet by the stop May 9th midnight, right? Midnight is midnight that same night, day, right? It says April 4th midnight. It's midnight of that day, not the previous day. Otherwise it'll be May 3rd midnight, right? May 4th midnight. You know what I mean by submitting your numbers, right? Remember that master spreadsheet way back in time where I made you enter your name and actually not your name, but your company name? That spreadsheet has columns for what your DCF value is, what your pricing is, and what your recommendation is. Clearly, you're not there yet, right? Your DCF value you've got at least for the moment, but that could shift between now and May 5th as to what your recommendation is. So we'll close trading for this class on Friday at close of trading, right? Because obviously you can't do it on Monday if you're turning it on Sunday. So you're going to tell me as of Friday what your recommendation is. Wait till Friday to make your recommendation. Why? What's the recommendation based on? Price, right? You can get your DCF value and you can get your pricing, but the world keeps shifting on you. So wait till the close of trading on Friday, put your recommendation in. So that's going to go in on May 4th. Why do I need that? I need that for May 5th's class. That's why I need it by May 4th, because I'm going to show you what you found. Now, undervalued, overvalued, most overvalued. So I need that on May 4th. May 5th, of course, your final project is due by I think 5 p.m. that day. So that is the actual written project. So May 4th is just the numbers. May 5th is that written up as a project. So I'll send you more clarity on that because there's already past projects. You can look at them, but I'll kind of pull it all together in tomorrow's email where I'll send a to-do list on what's left on the project as well as what the final format should look like. Less involved than you think. And then what's left? The final exam. And I've given you options, right? Well, Ahan, what are the options? First, you can take it in person or take it online. You can take it early or you can take it on, really, I mean, it's really one day, May 12th. So it's that day. You can take, it'll be essentially the same exam. The only reason I've given you both options, some of you might be traveling, so we'll work out. If everybody decides, I'll start a Google shared spreadsheet. If everybody decides to take it in person, I will get another room again, so you have 2 different rooms. So that's what's left on the class, yeah. Not necessarily. I'm still working on it because if I can grade it easily online with regular questions, I'm going to prefer to keep it regular because that way you don't have this all or nothing phenomenon play out. But I'm actually running a test quiz with a few people to see how easy it is to grade things online. Because if I get 300 people turning everything online, if everybody decides to take it online, it gets really messy to grade it online. I don't want to create that. So first, I want to make sure what grading it online is going to be feasible. I'll let you know by the end of this week what my decision is. Okay. So lots coming at you. So today we have one more item in the agenda. We're going to talk about valuing private companies, continue that discussion. So you can look at the slide, but it's not there yet. So let me turn that on. People who came in here, they wiped out all my Zoom meetings, so I had to kind of create it. So let's talk about private company valuation. So while the slide comes on, and I'm going to start with a question that I can frame in terms of, let's suppose I have 2 private businesses. Yara owns a privately owned business. She's the sole owner. You're all investors in a publicly traded company, and the 2 businesses look exactly alike, cash flows and growth. And my question is a very narrow one. It's about the cost of equity you're going to use to value that company. Same kind. So business looks exactly the same. Yara owns one. She's the sole owner. That's all her wealth is tied up in it. Your investors. Which of the companies is going to have the higher cost of equity? No, no, wait. Don't go there, right? You don't have to be marginal. If you're investing in a public company, that's out of your hands, right? You have to be price takers. So in a public company, even if you're not diversified, guess what? You entered the game. You got to play the game based on the marginal investors. It's not based on you, it's based on them. But you're an investor in the public company. You're answering for Yara or you're answering for yourself? You're investing in a public company. Yeah. Will have the higher cost. Tell me why. What is it that Yara sees that you don't? Same company, you're a public market investor. She has her entire wealth invested in it. So what does she see that leads her to having a higher cost of equity? Exactly. Her entire wealth is tied up in the company. So when she looks at the risk of the company, what does she see? She sees all risk, right? You don't have the luxury of saying, this is market risk, this is company specific risk. It'll get diversified away by whom, right? So today we're going to talk about adjusting the cost of equity for the fact that if you're not diversified, you see all risk. If you see all risk, you got to adjust the cost of equity to reflect it. There's a second item that's going to come up with private company valuation that's a little tricky. In all of the public companies that we valued, we've never talked about liquidity, right? It's not been an issue. So why aren't we dealing with liquidity? Obviously, it should be a factor for investors. So why, when we value public companies, is liquidity a non-issue? Samita, you want to try that? Why is liquidity not even being considered? So in a value company, you can trade, but when you trade, what price do you buy at and what price do you sell at? I mean, in the public market, there's a price, right, that you see. But is that just one price for a company? There's a spread. There's a price at which you can buy and a price at which you can sell. The price at which you can sell will be lower than the price. It's called the bid-ask spread. You know why we don't talk about illiquidity with public companies? It takes care of itself. So let's say you value a company, right? And you find it undervalued. You go to your brokerage account and you try to buy it. You're going to get it at the higher price in the spread. And if there's a lot of illiquidity, that spread can be wide enough that you decide not to buy the stock because the spread is too wide. The bid-ask spread in the market takes care of illiquidity, so there's nothing explicit you have to do. But if you're valuing a private business, illiquidity hasn't been dealt with directly. You have to bring it in. What kind of private business am I talking about? Let's say on your way out this evening, you're tired, you stop on your way out, that hot dog stand outside, and you buy the stand. Why? Moment of weakness. You take your entire savings, you buy that hot dog stand. And then you get back home and say, what the heck did I do? I sold all my stocks to buy a hot dog stand. I need to sell it off. You come back and you stand on the sidewalk there, and as people walk by, say, would you like to buy a hot dog stand? How about you? You look like you have a lot of money. Much more difficult to reverse a bad decision when you're talking about private businesses. You know what you do with private businesses up front? You value the private business and then you discount the value for illiquidity. So I understand the logic. But I want to ask you a pragmatic question. If you're going to discount the value and you're looking at 4 types of private businesses, I want to tell me what kinds of private businesses you might attach a higher discount to and what kinds of private. So let's start with the first choice. You have 2 private businesses. One is healthy and cash flow generating. The other is money losing and has negative cash flows. In which one would you discount the value more for illiquidity? And tell me why, with a money-making company, you settle for a lesser discount? And also, you have the cash flows coming in, right? Part of the reason you're selling is to get the cash flows. The business itself throws off cash flows. Your discount should be smaller. So you'd expect the discount to be smaller for money-making, cash flow-generating companies than money-losing companies. But illiquidity is also buyer-specific. Let's say I'm looking at 2 types of buyers. One is a long-term buyer who has no need for cash in the near term. Why? Because they're making enough money from their jobs. They don't need the cash. The other is a cash-constrained buyer, where you're one crisis away from needing the cash flows. Who's going to have the higher discount, the long-term buyer or the cash-constrained buyer? Yeah. Oh, you'd like to pay, everybody likes to pay a lower price, but think in terms of your need for liquidity. If you're cash constrained, you're going to say, I care more about illiquidity because I might need the cash next week. And if you might need the cash next week, you're going to preemptively pay less upfront because you might need the cash. Your discount should vary across companies. It should vary across buyers. Should it vary across time? If you're trying to sell a private business today as opposed to 6 months ago, I'm going to argue you're probably going to demand a bigger discount now than 6 months ago. Why? Uncertainties have increased. So if the market itself becomes more uncertain, the things that cause the price of risk to change, your illiquidity discount should also increase. One of my pet peeves with how private company appraisers deal with illiquidity is they treat it as a bludgeon. What does that mean? Every company, they knock off 20% of the value. And that makes no sense to me. It should vary across companies, it should vary across buyers, and should vary across time. So we'll talk about different ways in which people estimate discounts and whether they meet that test. One final question. You own a private business. Let's go back to Yara. She owns a private business. She's looking for a potential buyer for the business. So Yara, you want a high value for your company or a low value when you sell it? High value. So I want to ask, what kind of buyer will be most likely to pay you a high value? Is it going to be another private individual, a private equity fund, or potentially a publicly traded company? And tell me why. Because they don't worry about this diversification issue. They don't care. Why don't publicly traded companies care about illiquidity? Because after they buy your company, it becomes part of a publicly traded company. If investors want liquidity, what do? They sell the shares. Those two big issues hanging over private company valuations kind of go away. So today, those are the issues we're going to talk about. How to adjust cost of equity for lack of diversification. But already, we've kind of set the table for what's coming. So let's go back to where we were at the end of the last session. I'd set up, private companies. I said motive matters. Tell me why you want a value, because that can affect value. So I'm going to look at 4 types of private company transactions, starting with the most difficult. The most challenging is one private business owner is trying to sell to another private individual, private to private. Then I'm going to go to the other extreme. The easiest of valuations is private selling to a public company, because all the problems go away. The third, I'm going to talk about private going public. You basically go public, so it's an IPO. It's kind of a variant of the second, with a few twists added to the IPO process. And the last one is a private company that goes to a venture capitalist or a private equity investor to raise money. So it's not quite as good as selling to a public company, but it might get you partway there. So let's start with a private-to-private transaction and talk a little bit about what it is that makes a private-to-private transaction tricky. First, neither the buyer nor the seller is usually diversified. They're probably, in fact, specifically, the buyer is likely not to be diversified. I'll give you a classic example. Until very recently, probably until the last 10 or 15 years, if you were a doctor or a dentist, you owned your own practice. In the last 20 years, that's changed. Healthcare has shifted. You used to own your own practice. Unfortunately, time works on you just like everybody else. You get older as a doctor or a dentist. You get to be 70 years old, and you decide to sell your practice. And in the, again, going back 20 years, who do you sell your practice to? Another young doctor wanting to buy your practice. Why are they buying your practice? Because they get a whole set of patients that come with the practice. Now, if you're a 70-year-old doctor and you made a significant amount of money over your lifetime, maybe you have a 401k, you got money invested. But if you're a 35-year-old doctor buying your practice, odds are you're investing everything you have and more to buy the practice, because you got 10 years of medical school debt to begin with. Your balance sheet looks really bad right now. You're the exact opposite of diversified. So that's the first thing you deal with, is neither the buyer or seller meets that nice diversified requirement that we use to get to betas. Second, it's definitely liquid. You buy that practice and you change your mind 15 minutes later, you're going to go through a painful process of trying to sell that practice with an added complication of people who say, what did you find out in the 15 minutes that makes you want to sell the practice that quickly? So you've actually poisoned the well. Third, there's a key person issue. Do you see how this plays out in a medical practice? I mean, when you go to see a doctor, you don't see just the DR, you see the name after that, the person this is as much a personal relationship, less so than it used to be decades ago. But if you walked into your doctor's office and there was somebody you'd never seen sitting at that table, odds are you're going to be a little queasy about who this person is. You've never seen the person before. They have all your records in front of them. They say, I don't know you. Who the heck are you? And if this is actually a doctor's practice, you might leave that room, in which case you might be listed as a client in this practice, a patient in the practice, but you're not going to be a continuing patient. Which means if I'm trying to sell the practice to you as a 70-year-old doctor, you built this great practice, many of those people might not show up if you buy the practice from that because they don't know who you are. There's a key person discount. So lots of little technical issues we've got to deal with which can affect the value. So let me set this process up with a hypothetical, kind of simple private company that I'm going to value. So there are two players in this game. One is a French chef. The other is an investment banker tired of doing investment banking. Which role do you want to play? You play the investment banker, tired. It'll happen very quickly. It's not a question of whether, it's a question of when, right? I'm a French chef. I'm the furthest thing from a French, but let's say I'm a French chef. I'm a well-known French chef of this restaurant. It's a great restaurant. I'm trying to sell it. You're planning to buy this restaurant with your entire wealth. This is going to become part of your story. So you're going to liquidate everything. You're going to buy this restaurant. Okay? I'm going to give you access to my financial statements. Looks like it's a pretty successful restaurant. Last year, I had $1.2 million in revenues and $400,000 in operating income. And I was running pretty much at full capacity. At full capacity restaurant is, right? There are a certain number of tables, and chairs. You can have only so many seatings in a night, right? 2, 3, and you basically have them up. The firm has no conventional debt. The bank, in this case, the restaurant has no conventional debt, but it does have a lease commitment for that restaurant space. That's $120,000 each year for the next 12 years. Okay, so let's work through how much you as the investment banker will be willing to pay for this restaurant. So here are the past income statements, and I'm going to be open about what I have in those income statements and what I don't. So this is actually the official income statement. So basically, I'm not playing any games, tax games. This is what I made in revenues and expenses. But I've done the traditional accounting thing, which is lease expense are treated like operating expenses before 2019. And as a chef, I did not pay myself a salary. Why wouldn't I? I own the restaurant, right? What do I get? I get to keep whatever's left over. Why would I waste my time splitting into salary and I get the money anyway? You see why this is going to be a factor? You're going to buy this restaurant. If you buy this restaurant based on the operating income, are you going to overpay for this restaurant or underpay for this restaurant? Let's play it out. You pay.
Overpay.
And
Chef is the business.
Yeah.
It doesn't work then.
In other words, you pay the 400,000 the day after. Who's in the kitchen? You are. And the only thing you can cook up is structured products. I don't think anybody's coming to eat structured products, right? So what do you have to do? You've got to hire a chef. He said, I've seen enough shows on Food Network. I can cook French food. Try it out, right? The souffle is going to fall flat. I don't know whether you can make an egg, beat an egg to make the white stand up. I've never been able to pull that off. But I think that's a requirement to be a French chef, is to do all of those things. So we've got to fix that somewhere along the way, but these are the financials. It's not like the chef is trying to be deceptive. It's that you have to make sure you ask that question, do you pay yourself a salary? So let's start with the first step. I'm going to try to estimate a discount rate to use to value the cash flows. So the way we built up the discount rate so far is you get a cost of equity based on betas, a cost of debt based on either an actual rating or a synthetic rating. We took weighted averages based on market values. That's how we came up with cost of capital for public companies. Let's revisit each of those links. When I use betas, I implicitly assume that the marginal investor in this company is diversified and that the rest of the risk disappears. As a private buyer, remember I told you, you're taking your entire wealth and buying this business. You're the exact opposite of being diversified. You're completely undiversified. So I've got to factor that in. The second is I don't have market values. And why does that matter? The weights in a cost of capital are supposed to be market value weights. So let's look at the process you go through to get over those problems. I'm going to start the process exactly the way I would start with a public company. To get the beta for a public company, what did I do? I went and looked up other publicly traded companies in the space. I estimated a bottom-up beta. So here I'm going to give you two different ways, and I'll let you pick which one you think is a better way of estimating that the beta that you're going to use to value. One is I could take the beta of other restaurants. I'll go to Capital IQ, I download the betas for publicly traded restaurants. I come up with a bottom-up unlevered beta of 0.86. But I'll also tell you what's going to be in the list. You're going to get McDonald's, you're going to get TGI Fridays, you're going to get Chipotle. Imagine showing a French chef the list of companies used as your comparables. He's not even going to look at the numbers. He's going to get out of here. How dare you compare me to, thank God I'm Friday. It's Friday. It's not even on the same list, right? And it doesn't even make sense. I don't like French food. I hope I don't get into trouble on Twitter because of this. I just don't like it. But there are people who do. And how much does it cost to eat at an expensive French restaurant? A lot, right? So who spends $200 on dinner? And this is before drinks, entree, appetizer, dessert. Yeah. Two groups of people. One is really wealthy people or people who feel really wealthy on that day. The other is people spending other people's money. There are only two groups of people in New York who have that much of other people's. It's lawyers and investment bankers. So I could go that route and give you the betas of investment banks and saying the beta for a restaurant is a beta for investment banks. Or I could look at what else these people spend money at. So the second group that I'm going to look at are high-end retailers. Why? Because the same people who eat French restaurants also shop in that section of Fifth Avenue between 59th. Where does it stop? Around 42nd, it becomes cheaper territory. So basically that stretch, right? Gucci, Ferragamo, Tiffany's. And the unlevered beta for those businesses is 1.18. I'll show you what I picked, but which one did you pick as your unlevered beta? The restaurant beta, the high-end retail beta? I picked the high-end retail beta. Why? Because betas measure how you move with the market, and if you're a high-end restaurant, you're more likely to move with high-end retail rather than restaurants. So that's my unlevered beta. And if this were a publicly traded company, I'm almost home, right? But this is not publicly traded. So here's where I'm going to bring in what I do differently with private businesses. So one way to think about this, you look at the total risk of a company. Some of that risk is risk you cannot diversify away. Market risk, macroeconomic risk. Some of that risk is company specific. In a publicly traded company, what do? We focus just on the risk you cannot diversify away. What happens to the rest of the risk? We assume that investors diversify it away. That's what we do with public companies, and that's why we look at just the beta. But in this case, I don't have that luxury, right? I'm exposed not just to this non-diversifiable risk, but to the rest of the risk. It's like an algebra problem. If I could somehow tell you how much of the risk in a restaurant is company specific, you could bring it into your beta and your cost of equity saying that's the rest of the risk. Now, if you remember, the way we got betas for publicly traded companies is we ran regressions. There's the Bloomberg beta page, there's the raw beta, so you look it up for each company. But if you look at that output, there's also an R squared in that output, right? Remind me again what R squared measures? What does R squared measure? Or how much of the variance in your dependent variable is explained by your independent variable, right? That's a technical definition. What's your dependent variable here? The company. What's your independent variable? the market. So let me rephrase what the R squared there is telling me. It's telling me the proportion of variance in my stock that is explained by the market. Does that sound familiar? That's basically what this is, right? How much of the risk in a company. So the R squared in every regression is giving you a signal in this business, this is how much of the risk comes from the market. So here's what I'm going to do with private companies that are not with public companies. In addition to getting the average beta for the sector, I'm going to get the average R squared because these are all public companies that can look up the R squared. And that R squared is going to become the basis for what I'm going to do to adjust your beta. So here I'm going to throw in a kind of what seems like a tangential reality. Betas are measured in terms of standard deviations. R squareds measure the proportion of variance that is explained by the market. So instead of using the R squared, I'm going to take the square root of the R squared, which gives me the correlation. So I take the average beta for companies, 1.18. I take the average correlation and think of this as an algebra problem. If I were a diversified investor, I would be okay with a beta 1.18. That half of the risk that's market risk. But if I'm not diversified, I'm going to be exposed to all of the risk, which is twice as high as the market risk in this case. The beta that I'm going to see in this company, or Yara is going to see in her company, is going to be 2.36 rather than 1.18. It's the same company because she sees all of that other risk that normally would be diversified away. The lower this correlation becomes, the higher the total beta effect is because more of the risk is company specific. I'm bringing it in. That's the beta that I'm going to start with as my unlevered beta. That's the difference between public and private, but it's only because the buyer is completely undiversified. Now, once I get the unlevered beta for a public company, what did I do to get the levered beta? I brought in the debt to equity ratio of the company with debt and equity defined in market value terms. And here I'm going to run into a second problem with private companies. I don't have a market value of equity, right? It's not publicly traded. There are three choices I have. One is to call the owner of a private business and say, can you give me a target debt to equity ratio? I've tried this, it never works. The reaction I get is a target what? I hang up the phone. There are two other approaches, and you can try either. One is to use the average market debt to equity of publicly traded companies in that space. What are you implicitly assuming? There's a reason retail companies have a certain debt ratio, or restaurants have a certain debt ratio. If I'm a private company in that same space, my debt ratio should be roughly similar. You're a privately owned software company, I would expect your debt ratio to be really low because publicly traded companies don't do it. It's going to save you a whole host of trouble, so that's one choice. If that makes you uncomfortable because it seems like you're assuming private and public companies do the same thing, there's a second choice. You don't have a market value of equity, but in your valuation, you're going to come up with an intrinsic value of equity, right? Could you use that to come up with the debt to equity ratio? Yes, but it creates a secondary problem. You see what the secondary problem is? It creates a circularity, right? Because to get the intrinsic value of equity, I need a debt to equity ratio. To get the debt to equity ratio, I need an intrinsic value of equity. But there's a way around it. If you check the iteration box in Excel, it'll take care of itself. It'll actually do this for you. So the second way to get a debt to equity ratio for a private company is to use that iteration process and use your estimated value of equity. But either way, you're making a call. It allows you to come up with a levered beta. In my case, I'm going to stay with the industry average, which was 14.33% for the debt to equity. Come up with a levered beta of 2.56 and a cost of equity of 14.5%. So as the investment banker trying to value the restaurant, you're going to give it a higher cost of equity than you would have in a public market space because your entire wealth is going to be tied up in the restaurant. I've got my cost of equity. To get to a cost of capital, I need a cost of debt, right? So I went to Moody's and I said, can you give me the rating for this 5-star French restaurant? You know what I got? Absolutely nothing. Moody's doesn't go around rating small private businesses. But there's a way out of that, right? With public companies where I could not get a rating, what do we do? You remember, Jake? Don't have a rating? I computed an interest coverage ratio and went to that table and said, you know what, I'm going to come up with a synthetic rating. That I can do for private businesses because all it needs is operating income and interest expense, and I should be able to get that for a private business. So I did that for this private business, and I came up with a synthetic rating of double B plus and a default spread of 3.25% based on that. I've got my cost of debt. I'm almost there. I've got this cost of equity based on what I call this total beta because it captures total risk, and a cost of debt based on a synthetic rating. I take a weighted average, sticking with that industry average debt ratio. I end up with a cost of capital of 13.25%. I'm not changing any of the first principles in how I'm doing, but I have to be pragmatic. I can't use the market beta to come up with the cost of equity because the buyer is not diversified. That gets factored in. That's going to be the cost of capital I use to discount the cash flows. Any questions about the process, right? So all you have as an extra step is that correlation of your business with the market. I don't know where you got the bottom-up betas for your company, but if you got them off my website, you probably looked up that table where I had the industry and the unlevered beta by industry. If you stay on my data page, I also have a second table for total betas, which is basically the beta that you saw for the restaurant by industry. So if you're a private business in the chemical, let's say you're a privately owned chemical company, there's a chemical business, and then there's a total beta for it where I bring in both the beta and the correlation to come up with the total beta by business. And those numbers are going to be significantly higher than the market beta. Once in a while, there are people who go to the wrong table because they're trying to look up a beta, and they go to my data set and they pull the total beta table down, not really recognizing what a total beta is. And then I get this frantic email saying, I'm using your beta your beta averages by industry, and it tells me that my beta is 3.35. How can it be so high? And I emailed them back saying, are you sure you're looking at the right beta page? And they said, it says beta. And I said, is there a word before the beta? And it says total beta. And I said, that's why you're on the wrong page. That's a page for people trying to estimate cost of equity. For private transactions, the buyer is not diversified. It's not meant for public companies. So you get much higher betas, much higher cost of equity, much higher cost of capital. Yes.
Um, often that's like
Don't, it's not worth it, right? At this stage, don't even mess with that. You just want a discount rate to get started. Otherwise, this iterative process starts to multiply in every side, right? So just stay with the market value equity, right? Second step, I stopped and cleaned up the financial statements. What does that involve? First, do everything we did with public companies to clean up the financials. This was 2000 and whatever, well before the 2019 rules. Leases were treated as operating expenses. So what did we do with public companies? We capitalized leases. We treated them as debt. If the private business is R&D, what should we be doing? Capitalizing R&D. Luckily, this restaurant didn't have any R&D. Made me very suspicious. They had a big R&D expense. So what exactly are you doing research on? And there's one final adjustment I made. Remember that chef that you did not no longer have in your kitchen? I hired a chef for you because I don't think you want to spend your time in the restaurant cooking food. You can, but the restaurant will be empty sooner rather than later. Then it'll go bankrupt. So I would rather spend the money, hire a chef. Remember though that chef, it's not just how well they cook, it's whether they have the profile to draw people in. So my suggestion is go to the Food Network, find a name that people recognize, hire the guy, and you can probably get away with them being a very average chef if a lot of people know who he or she is. That's the 150,000 that I've added on. It's something you have to explicitly ask questions on because no owner is going to say, I didn't pay myself a salary. It's something you have to ask. It's your question to ask. Lisa is valuing her father's consulting business. And I'm sure, how many hours a day does your dad spend on his business thing? Does he ever answer your calls? He's probably during a certain time. You have to text him and maybe he'll get back to you. I guess he spends a lot of time on his business, right? No, no longer. So there you might say, look, it won't cost me much. I could hire somebody from a temp service to step in for the 2 hours to do this. But if you spend 16 hours, clearly you might need two people to fill that, right? So you got to be realistic about what owners do and bring in people to kind of fill in that space. Step three, you got to ask, what is the effect of the person running the business? And especially with small business where there's a personal component, this is going to be an issue, right? This is a French restaurant with a chef. People come to the restaurant not because they just want to eat French food, but they want to eat French food cooked by this person. So if he sells you the business and leaves, there's a very real chance that some of those people will no longer come to your restaurant, right? In this case, I've estimated that you're saying, how do you come up with a 20% drop in operating income? Maybe you got to stand outside the restaurant, and as people leave the restaurant, say, you know what, this guy who cooks here, he's going to leave next week. We're going to hire somebody new. Will you still come back to the restaurant? I don't know how you do it. Maybe do surveys, but there is going to be a loss. I'll give you a personal anecdote to show the effect of this key person. I have 4 kids. They're no longer kids. They're all grown-ups. But they were kids once, which kind of goes without saying, but might as well say it. And I never had braces, but 3 of my 4 kids had braces. And I didn't realize how lucrative this is to the people. I thought you put the braces on and then 10 years later they just took it off. It turns out that it's a repeat business for dentists, which is they put the braces on, then you got to come in every month, they tighten it, they loosen it, they do all kinds of neat stuff, and then charge you a couple of $100 for doing that. So 3 of my 4 kids had braces, and I was responsible for taking them to the dentist. Really nice guy named Howie. So my 3 kids and I would visit Howie every month. And while he had a factory going of kids sitting in chairs and people adjusting braces, and Howie was a master of ceremonies. And he loved talking about the market. So every time I brought my kids in, he would be taking, I have this stock. Do you think I should buy it? And I could not be rude because 3 of my kids are with open mouths, I don't know what kind of torture can be inflicted on them if I give. So I usually, and I liked how he was a nice guy. So I take my 3 kids in, one occasion, and he says, I'm thinking of retiring. And I said, Howie, you're 42 years old? He says, no, I've made a lot of money. I said, I know. I check my credit card every month and I see the charge. And he said, well, I'm thinking of selling my business. Do you think I can get a lot of money? He said, he mentioned the amount he made in the previous year. It's a mind-boggling number, you know. And he said, do you think? And I said, yes, but you won't get as much as you think you're going to. He said, why? Look how much money I made. I said, Howie, you're a dentist for kids. If somebody buys this practice and puts them in the chair, and I walk in with my 3 kids and I say, who the heck are you? And he says, I'm your kid's new dentist. I'm saying, no, you're not. I've never seen you before. People factor that in. They will discount the earnings for the fact that you won't be here anymore. He's a little disappointed. He said, can I do something to make the discount smaller? And I said, yes. I gave him a suggestion. What do you think he should do? Not, there's actually an intermediate. That's one solution, right? Can he have his cake and eat it too? Can he sell it and not have the key person discount? He has to do something for that to happen. I said, sell it and stay on for a couple of years. He said, but I don't want to keep working. I said, get a nice massage chair. Put on some, get some nice music, sit in the chair, and when your patients come in, walk them over to the chair, kind of make small talk. How he was really good at small talk. Introduce them to the new dentist, kind of transition this period. It means that you have to wait 2 years to leave, but you're going to get a much higher percentage of value. And if you're the person buying this practice, you know what you have to absolutely get in that sales contract, right? You want to make sure that Howie can't start a dental practice next door and suck up all your patients. Right? That's going to be a worst case scenario. You buy the practice, the next day Howie opens next door, all your patients go next door. You're sitting there saying, where are my patients? They're all next door with Howie. Something you don't think about with public companies, but key person issues come up. In fact, this is something I know about a year. I used to think that this was something specific to private business, but it turns out that key people are involved in almost every business, right? Even at publicly traded companies. And it doesn't always have to be somebody at the top. It could be a key top manager. Why? Because they set the narrative for the company. Will NVIDIA be less valuable if Jensen Huang is not there? I think so, because in a sense he's viewed as the driver of the business. That's mean he sets a narrative for the company. But the key person could be a key salesperson. Let's say you have four salespeople. One can be really good and account for half of your revenues. You buy the business and that person leaves, there goes half your business, right? It could be a key spokesperson, maybe an outside spokesperson. Say, why would my value rest on an outside spokesperson? You know, the day Tiger Woods drove his car into a tree, Nike lost $4 billion in market cap. Why? He was their central player, right? He was a celebrity. He was the spokesperson, the face of the franchise. The day Michael Jordan left basketball, and remember that 1 year he spent playing baseball. No, again, Nike lost a few $1 billion in value. People saying, you know what? You built your entire business around the Air Jordan. I don't think they're going to do the same thing for a baseball Jordan because he's not as good. It's kind of a cost. It could be a key. It could be a key design person. You've heard of John Ive? Nobody's heard of John Ive? He worked at Apple for he left about 5 years ago, but he was the person in charge of design at Apple. So when you look at your iPhone, that is a John Ive. You look at your MacBook, it basically reflects. And Apple is a company that thinks seriously about design. It's a company where actually people buy stuff because it looks cool. Could be a design person. It could be a key production person, right? If you have a factory, there might be a person, a foreman at the factory who basically is really good at making things run on time. The person leaves, the factory falls apart. The most unlikely scenario is a key finance person. There's not much finance people can do that's special or unique. Right? What are you going to do? Lower the cost of debt single-handedly? Change the beta for your company? Maybe you can pull that off. Pull up different Bloomberg beta page. Look, our beta magically went down by half, but that's pure deception. Key people can be at every part. And to value a key person, the process is always the same. You value the company twice. So think of it as a switch that you turn on and off, right? The first, you value the person with the key person in the company. And the second, you ask yourself, what would happen to the company if the key salesperson left? The key celebrity spokesperson is damaged. That difference is the value of the key person. You know what the company should try this on? Tesla. Who's the key person? Musk. 10 years ago, the switch on and off, the effect was absolutely undeniable, right? The switch with Musk off, Tesla was worth a lot less than with the switch on. Today, cut both ways. You turn the switch, is it on or off? I have no idea. The value seems to be moved. That's the effect of the key person effect becoming more muddled. So key people can be involved with private company, can make a difference. So in this case, I'm going to assume that the key person costs you 20% of your operating income. In this case, the chef leaves, 20% of your revenues leave. And just because you're valuing a private company doesn't mean you can forget all the stuff we talked about in the context of valuing public companies, especially in the context of growth. Remember the lesson with growth. To growth, what do you have to do? You have to reinvest money. How much do you have to reinvest? It depends on your returns on capital. That is not just for public companies, it's true for every business. Here, I'm going to assume that the restaurant will continue to grow its income at the inflation rate. I'm allowed to grow it up to the risk-free rate, right? Why am I not setting it at the risk-free rate? I'm setting it at the inflation rate. What's the difference between the risk-free and the inflation rate? It's that real growth you're going to get, right? I don't want real growth here because what does it mean when you have real growth in a restaurant? You can't just put more chairs in a restaurant, fill the space up. It's already filled up. You can't have 3 seatings instead of 2. Remember, it's an expensive French restaurant. You can't rush people. It's been an hour and a half. You're taking too long. Leave now. It's basically what it is. So if I'm putting in real growth, I either have to expand the restaurant or build another restaurant, and I really don't want to deal with that. If you told me those were your plans, I'd bring it in, but here I've left the inflation rate. So you're saying, why would I need to reinvest if I'm growing just the inflation rate? because those ovens, those fancy French ovens you have in the kitchen, will have to get replaced every 10 years, right? And if there's inflation that's driving up your revenues, that inflation is also going to affect the cost of the French oven, which has to be built in. So that reinvestment rate of 10% is what you're spending to maintain the kitchen and the restaurant in working order because you got to continue to generate. I considered actually making it just a finite set of cash flows. You see why with a privately owned restaurant you might want to do it? What does the restaurant sit on? Land and a building that you've leased, right? Let's say it's in this case, a 12-year lease, and you're not sure whether you can renew the lease after 12 years. You might say, look, I'm going to do this for 12 years. At the end of the 12 year, the landowner, the building owner might increase my lease by 300%, knowing that I make money. So it's a choice with private companies you might make of having a finite life because the business is not going to last forever. So I'm ready to do my valuation. I start with the adjusted operating income, adjusted for what the 20% drop in the key person leaving. I take out the tax effect. My cost of capital is 13.25%. I grow with the inflation rate, and given that growth rate, I have a reinvestment rate of 10%. Remember, if you're already in stable growth, I don't have to do 10 years of cash flows. It's a waste of time. I'm going to get the same answer. Might as well use the stable growth equation right now, which is expected earnings next year after taxes minus reinvestment. So it's the same definition of free cash flow. Divide by my cost of capital minus growth rate, I get a value for the restaurant of 1.45 million. But there's lease debt, right? The equity in this restaurant is worth whatever the value of the restaurant is minus the present value of leases. I get 521,000 as the value of equity in the restaurant. If you look at that number, it's actually like 4 times net income in the previous year, which sounds like a really low number, but that's what you get when you end up with higher discount rates, not much growth in a private business. Any questions about the process? There's one final step, right? I have to bring in illiquidity. The problem, again, I think, is not that illiquidity shouldn't be considered as a factor. I think it should. It's how to bring it in, because you can't just apply the same discount to every private business. It should vary across companies. Talked about healthy versus unhealthy, money making versus money losing. It should vary across time. You're in a crisis market or in a nice buoyant market. And third, it should vary across buyers, long term, short term. Already you can see that if you're a private company appraiser, there's more you do in this process than in a public company valuing the company, right? Because you got to know who the buyer is, you got to ask questions. You think that's a lot of work. Be glad it's a lot of work, because with a public company, ChatGPT can replace you because it's all mechanized. With a private company appraisal, you might have to bring something to the table that an AI entity might not be able to do. So I'm going to talk a little bit about illiquidity discounts in private company valuation, how it's done, and why I think we need to rethink it. In most private company valuations, the appraiser values the company using DCF or whatever they call as a DCF. And then they knock off 20 to 25%, maybe 30% of that value for illiquidity. It's like a standard part of the process. And there are 2 sets of studies that they use to back up that big discount, because it serves them well to knock value off. You're saying, why is it good to knock value off? Because 80% of private company valuations are for tax purposes or for legal purposes. We want to show a low number because you want to pay less in taxes. So they want a lower number. So the big 30% discount works in their favor. So the first set of studies are studies of what are called restricted stock. Remember, to observe an illiquidity discount, you want to be able to pick something where you can see what the price would have been with liquidity and the price without liquidity. That's tough to do in a private company transaction because all you observe is the transaction price. Restricted stock are stock issued by publicly traded companies where if you buy the stock, you're restricted from trading that stock for, it used to be 2 years. Now it's 1 year from the time the stock is issued. Do you see how this is like a gold mine for people who look at liquidity? They're publicly traded, so you can observe the market price on the regular shares. Then you can see what people pay for the restricted shares, and that difference is an illiquidity discount. So for 50 years now, private company appraisers have used restricted stock studies to back up 30, 35% discounts. The other set of studies, and this is more recent, last 30 years, is to look at what happens just before companies go public, that are pre-IPO, in the months before, 6 months before. Because if you're, let's say there are 5 venture capitalists in a private business and you're going to go public in 6 months, and you want to just cash out and you're trying to sell to another venture capitalist. Even though you might have an expected offer price, you're not going to get it, right? Because you're cashing out early, because you want the cash now. You don't want to wait 6 months. You can observe the price at which those transactions happened relative to the IPO price. It's going to be a discount. You can observe that discount. They're both incredibly flawed and we'll talk about why. But those were the basis for the big discounts that private company appraisers used. So let's start with restricted stock studies. For much of the early part of the restricted stock study research, first 20 or 25 years, here's what researchers did. They took all companies that issued restricted stock, they looked at the discount that people demanded when they bought these shares, and they reported a median value, 30%, 35%. And then appraisers took that and ran with it. 30 to 35%, they'd go in front of court and say, restricted stock studies tell us that the discount is 30 to 35%. We've knocked off 30 to 35%, and you moved on. About 25 years ago, Bill Silber, who used to teach the foundations of finance class in the MBA program before my class, did a study, and he laughs about it because it is a throwaway research study during a summer where he looked at the restricted stock studies and he looked at the discount on each transaction, and then he said, can I explain the differences? Why do some of these stocks sell at lower discounts than others? And he found that companies with high revenues, the discount was smaller than companies with low revenues. He found that money-making companies, the discount was smaller than money-making companies, and he set up a regression. He said, let me try to explain the differences in discounts, looking at the revenues, whether you're making money or losing money, whether the company has cash, and finally, whether the buyer of the restricted stock has some other relationship with the company, because maybe they'll accept a lower discount. That was so collectively restricted stocks companies give you a benchmark, 20, 25, 30%. And what Bill Silber is saying, that discount should be different across different companies. So I actually took Bill's study and I ran with it. I said, okay, let's say your base discount is 25%. This study allows me to quantify what happens to a discount as revenues get higher. It should get smaller. This study also tells me what should happen to that discount if you have a money losing versus a money making company. So here's the table that I drew, and here's how it would work if I were a private company appraiser. Say I set up office, I'm a private company appraiser, you come in with your company. I value your company, and then I'm going to get ready to apply a discount. I ask you, how much do you have as revenues? Let's say you say $100 million. Then I ask you, do you make money or lose money? And you say, I make money. $100 million, you make money, you should have a discount of about 23%. If you said you lost money, the discount would have been almost 30%. Next person who walks in has $1 billion in revenues, is making money, the discount is going to be closer to 16%. So basically, I'm taking my base discount and using that regression to adjust what that discount should be based on money making, money losing. I'm starting to move towards a discount that's going to vary across companies rather than be a fixed number in every company. But it's built on the restricted stock studies, which might, as I said, might themselves be fatally flawed. So what I'd like you to think about is statistically, what is the problem with a restricted stock study? Where do you think the statistical problem comes? So take the median discount. What happens when you're a company issuing restricted stock? You got offered at a discount of about 30, 35% on the current market price, right? That's a lot of money to leave on the table. So why would a company do that? Why would a company issue restricted stock? You're desperate, right? You're Weight Watchers, nothing is working. What do? You offer a huge discount. You know, in statistics, one of the biggest sins is sampling bias. Do I have a sampling bias with restricted stock? Absolutely. My sample is composed of incredibly crazy companies on the verge of disaster. So a big chunk of that 35% discount has nothing to do with liquidity. It's got to do with my sampling bias. Look at the IPO studies. because the numbers there, sometimes I read a study and I said there is zero chance that this study is actually true. They're published studies. It went through the review. I don't care if it went through the review process. It doesn't pass the smell test. The IPO studies don't pass the smell test. So here's what you do in an IPO study. You take companies that go public, you look at their offering price, and then you work backwards in the 6 months before the offering. You look at transactions that happen, and you see how much the prices were lower on those transactions, how much of a discount. And these studies claim there's a 40 to 50% discount on the offering price. And there is no chance that is true. And here's why. Let's say you're a venture capitalist in a company, it's planning to go public 6 months from now at $100 per share. Would you sell your stake to me at $50 per share? You'd be out of your mind to do it, right? No, so I remember I sat in on one of these research study presentations. I said, that is not true. That cannot be true. But they said, we have the data. I said, okay. So what do you have data on? They said, we took every company that went public, we went back, and this is true. Where's the bias coming in? Looks like they've done things right. They've counted every company that went public. What did they not count? That, but still, uncertainty still doesn't mean a 50% discount, right? The expected value should be. Is every company that plans to go public actually go public? No, some companies talk about IPOs and they pull the IPO, right? You know what the study's missing? It started with companies that went public and work backwards. What should have, if you truly wanted an IPO study, what do you need to do? You need to look at all companies that plan to go public and record these transactions, including the companies that never went public. And they're the people who sold early will actually end up with this much higher number than the company was worth. The bias is coming from the fact that you're missing those companies, the companies that never went public. So both these studies are insanely biased because of sampling bias. But for 4 decades, private company appraisers got away with this in courts. And you know who the biggest loser from this was, right? The IRS on the other side. You might have no sympathy for the IRS, but essentially that's less tax revenue being collected because you're letting people mark their companies down 30, 35, 40%. So the way the IRS played it, they were cheap on their expert witness. So here's what would happen. The private company appraisers, the expert witness would get up there and say, discount should be 40%. The IRS's expert witness would say, based on the restricted stock studies, they'd go to the lower end, 30%. And what do the courts do? They'd split the difference and give you a 35% discount, which is a win for the taxpayer, right? Until one final day, the IRS decided to actually spend the money and hire a guy who knew statistics. And he said, the problem here is not with the high and the low end, it's just there's a sampling bias. And he actually went through that 35% median discount and he broke out how much of that discount was because of illiquidity and how much from the sampling bias. He concluded it's 22, 23, 24% of that discount comes from the sampling bias. So today, private company appraisers are much shakier ground now because there's somebody on the other side saying, hey, look, the sampling bias. Took them a while, but they still stick with it because their response is, what else can we do? My response is there's something that you can do. What did we say was the discount with publicly traded stocks? The bid and the ask price, right? Can I observe that with every publicly traded? Absolutely. If I took that spread and stated as a percentage of the stock price, I'm getting a measure of the illiquidity discount across every publicly traded company, right? Think of my sample size. It's not the 60 restricted stock companies, it's so there's no sampling bias. And if I take that spread as a percentage and relate it to differences across public companies that I can also get for private companies, for instance, the level of revenues, whether you're making money or losing money, even the trading volume, I can tell you which kinds of companies have high bid-ask spreads. Smaller companies, money-losing companies, companies with the trading volume is really low, and which companies have really low spreads. Companies like Apple, big companies, money-making companies, lots of liquidity. And that equation that I have for the spread, I can use to get a spread for a private business. You say, what's a spread even do for the bid-ask spread is a measure of the illiquidity in the company. So if I can get that estimate for a private company, I've essentially got an illiquidity discount. So let's see how this plays out. If I took my restaurant and I use the bludgeon approach, which is what appraisers use, I just knock off 25%. Why? Because I do that for every company. If I did the refined bludgeon approach, I don't even know what a refined bludgeon would be, but I start with the bludgeon and adjust for revenues, I do get a number that's higher because this is a really small restaurant. But if I take the bid-ask spread and plug in the numbers for this company, the revenues, the fact that it's money making, and the fact that you never trade, it's basically like a publicly traded company that never trades, I get a bid-ask spread that's 12.88% of value, saying, what does that tell me? That is my estimate of the illiquidity discount at this business, reflecting its revenues, its fact it's money making, the fact that it never trades. I think this has, that regression you saw though is about 10 years old. You're saying, why haven't you updated? Because it was a pain in the neck to do. I went to Capital IQ. I look for, if Capital IQ gave me a bid-ask spread, I would do this every month. It'd be no brainer, right? Capital IQ does not have, I don't know why, they have a float percentage, all kinds of crap, but no bid-ask spread. There's a different database which has the bid-ask spread. I had to combine two databases of thousands of companies. I will never do that again. No, actually, let me take the bet. Maybe I'll do it again one day, but I don't want to do it every year. But that's, if I were a private company appraiser, I would do it because this is my livelihood. I'm not a private company appraiser, so if they want to do it, they should do it. I'm not doing it for them. Why would I? But I think it offers more chances of getting a better estimate. So that's private to private. Everything that is a mess will kind of play out. Let's talk about private to publicly traded companies. Let's see what's going to be different. You're telling a publicly traded company, the company doesn't have to be diversified, its investors can be diversified, right? So that total beta discussion goes out, so I can use a market beta. And illiquidity is no longer an issue because once a public company acquires you, investors can be liquid because they can trade the shares. So here's the first thing I did. I recomputed the cost of capital, and if it's a buyer's a public company, your cost of capital is going to go back to a market beta. Cost of capital is going to be much lower, 8.76%. You don't have that diversification issue. And when I actually value the company, there's no liquidity discount either because that 12.88% disappears. So take a look at the difference in value. If I sell to a private buyer, I get 453,000 or 454,000. But if I sell the same business, the same restaurant to a publicly traded company, I get $1.484 million. Ready? You can be the owner of the restaurant, the chef, right? 454,000 is your value selling to another private individual. 1.484 million is your value if you sell to a public company. Obviously, you'd like to get the 1.484 million, right? Which one are you more likely to get, and what will it depend on? First, it'll depend on who's sitting across the table. If it's a private individual, it's going to be 454,000. If it's a public company, will you get the 1.484 million? You're going to start your bidding at 1.484 million, right? But if I'm the public company, what am I going to counter you with? 454,000. No, don't start at 1 million. I'll start at 455,000. I'll try to be magnanimous. I'm giving you $1,000 more. And guess if that plays out as a bargaining, who's going to win that bargaining game usually? The public company. I might pay you 500,000. I'm doing you a favor. 46,000 more than you could have gotten another transaction. But I'm walking away with 900. And if I do this on restaurant after restaurant and I roll them up and I make this a public company, think of how much value I'm going to be able to gain. You know, at one point in time, garbage businesses across the country were local and owned by families, controlled by the mafia in some cities, but that's a different story, right? And a company called Browning Fairs came along, and what it did was basically roll up private businesses across the country and essentially become a publicly traded company. And it created immense value along the process for itself because it claimed that difference. But you can see private to public essentially. So if you're a private business owner negotiating with a public company, odds are you're not going to get, unless you can pull off something. What do you have to pull off as a private business owner to try to get closer to 1.484 million? Get another get another public company involved, right? Because you get two public companies trying to buy you. They know the value is 1.484 million. If you're luck, so the key here, if you're a private business owner, is to find the right buyer. Hopefully, the right buyers, two buyers who are diversified. Let them play off. Would your answer be different if it were a VC or a private equity investor on the other side instead of a public company? What would be different?
Private equity strategy, where diversification of the market's not.
Most VCs tend to be sector specific, right? Technology so they're not fully diverse. They're more diversified than that individually try to buy it, but they're not. So they're going to fall in terms of the correlation somewhere between the individual investor who's not diversified at all and market. If your potential buyer is a private equity investor, does the identity of the private equity investor make a difference? If it's KKR or Blackstone, they're publicly traded companies. They're diversified across multiple businesses. They should be. You can see why even within this space, if you look at the bidding, it can be different depending on where you fall in that spectrum. Set up at least private company for an IPO. Okay. Everybody understand the process in which most companies go public around the world. Let's say you're a private business and you want to go public. Why would you go public? Why would a private company go public? One is it allows owners to cash out, right? That's one, venture capitalists, etc. But you were raising capital from VC, so why is it better for you to raise your equity from public equity as opposed to VCs? You might get better terms, right? Remember that beta effect, right? The total beta effect, almost. So you decide to go public. Going public comes with a whole stack of other stuff you have to do, right? You have to file a prospectus, you have to have information disclosure. So it's not an easy decision. Companies delay it sometimes, and we'll talk about the characteristic companies, but you decide to go public. What's the next step after you've decided to go public? You hire a banker, at least historically. What does the banker do? They create a syndicate. Sounds like a mafia again, but it's like a banking mafia. And what does the syndicate do? They do first, before they even do a roadshow, they test out prices. They call investors and say, you have this company and how much should you pay? We'll talk about that process. Then they take you on a roadshow, which means they try to go around and market you to investors. And then they price your company towards the end. And then they guarantee that price. It's called an underwriting guarantee. Sounds like a great deal, right? So why do they do this? Because they're magnanimous, sweet people, or what is it that bankers get out of this? No, but they have to get something even without the price shooting up, because right, they get a percentage of the capital you raise. If you're raising 100 million, they get to keep 6 million, right? The price rising, they don't make money on, because remember, they don't buy the shares. It's somebody else who makes money on the shares. So let's talk about what you would do if you had to value a company for an initial public offering. This was my valuation of Twitter on October 5th of 2013. October 5th of 2013 was the date that Twitter filed its prospectus for its IPO. They'd announced they're going to go public. They'd filed a prospectus. When I value companies for IPOs, I like to value them right after a prospectus is filed and before the bankers even start to mention prices per share. You know why? Remember we talked about bias? Right? Subconsciously, it's going to weasel its way into your head, right? So bankers say $20 per share. Whether you like it or not, the $20 is going to start to, so when you do a valuation, you get 7, you say, I must have done something wrong. Let me try a higher growth rate. So this was my initial valuation of Twitter. And my initial valuation, I did almost everything I would do with a public company, which is, tell a story about growth and margins and reinvestment. The story I told was of an advertising company, an online advertising company, that would succeed as a secondary advertising place for most advertisers. Why? Because a Facebook or a Google can be your primary advertising, but Twitter I felt would be something you'd advertise on in addition to something. That kind of reduces the market size, but it's still a pretty successful story at the end. That gave me margins and cash flow. So if you think about the FCFF simple Ginzu spreadsheets, revenue growth, margin, sales to capital, I did that. And then I estimated cost of capital, just as I would do for a public company, right? Because it is, in fact, effectively a public company. Saying, how do you get a beta? Since I never used regression betas to begin with, that wasn't an issue. I used the beta of the online advertising companies on. I finished my valuation. I get a present value of the operating assets. What do we do then? We usually add cash, right? And here comes the one additional step I had to do for Twitter that would not do for a public company. What does going public mean? You have an offering, you issue shares. When you issue shares, what happens? Cash is raised, right? And you got to tell me what you will do with those offering proceeds. In the case of Twitter, they were going to keep the proceeds in the company. What does that mean? The day after the offering, what's going to happen to their cash balance? It's going to increase by the offering proceeds, $1 billion. The day Alibaba went public, they raised 20 billion in their initial offering. Their value jumped by 20 billion because effectively your cash balance went up. So that's the one technical change is you see that. So to value an IPO, you're not doing anything different than with the traditional any other company. The only difference is you got to figure out what to do with the proceeds. So first thing is, I'm going to talk about the different things that can be done with proceeds in an offering and how they play out differently in evaluation. The second is by the time a private company goes public, it's accumulated a whole set of investors, venture capitalists, and each venture capitalist has come with his own or her own security that they've created. Preferred shares. There's a multiple classes of shares and warrants and options, all that have accumulated for the company that you got to take care of, got to deal with. The second is the process itself is going to affect the number you put on the company. What do I say investment bankers do? They look at your company and they try to put a number on your company that they hope to get on the offering day. Is this a pricing mission or a value mission? What's your job as a banker? That's clear, right? Demand and supply. It's a pricing mission. So you're going to see a pricing start. And in addition, you've given a guarantee, right, of that price. So once you get that price, do you want to discount the price or you want to reduce your risk or put a premium on the price? You want to discount the price because if you set the price too high, you got to come up with that money. Investment bankers are actually open about this. They say price the company, knock it down 15%, because that means we have less risk to face. So here's the first thing. When you look at the proceeds, there are three things that you can do with the proceeds. One is you can keep the cash in the company, which is what Twitter did. The second was what Spotify did on their IPO, where they let VCs and owners cash out, which means the cash just goes through the company. It's a conduit. That's an easy valuation. You can just ignore it. The third is if you're a private company that's accumulated a lot of debt, you might use the proceeds to pay down the debt because you really shouldn't be carrying debt. In which case, where will it show up in your valuation? Through the debt ratios in your cost of capital. Whenever you look at a prospectus, check the prospectus out because somewhere in the prospectus, they will tell you what they plan to do with the proceeds. Okay? So there are IPOs that are happening even now. You can check out the prospectus. In the case of the Twitter prospectus, they told me that they were going to raise about $1 billion and they were going to use it in the company. They were going to keep it in the company. That's why you saw me add $1 billion. In fact, if I told you that they were going to keep only half of that and let owners cash out in the other half, what would you have done differently? I added $1 billion, which was the proceeds. If only a half was kept, I would add half of that, right? This is not. Yeah. Basically, they just, whatever proceeds. Remember, effectively, if you're an owner, the day of the IPO, your ownership is converted to share count, right? You could, so basically your share count will this has to be pre-arranged before the IPO. So basically, these are transactions that are arranged because if you don't, then you get locked in. So I will stop at that. Next class when we start, we'll talk about, what to do about those other claims and how it plays through. Send it to me again. I don't know, maybe you put the wrong subject.
My perfect DCF and then name.
Send it again, Dan.
Okay. You just email to, right? Thank you.